All right, welcome everyone. Thank you for joining us today. Today we are going to be talking about first generation down payment assistance and the opportunity for using first gen as an eligibility criteria to help close the racial homeownership gap. So today you will be hearing from some of your peers. We have Stephanie from the city of Edina, Jamie from Woodbury, and Tanisha from Ramsey County. And so they're going to share a little bit about their programs. But before we get started with that, I'd like to just remind us and ground us a little bit in the work that we're doing, both in terms of talking about the DPA best practices and then just level setting on the racial homeownership gap. We'll talk a little bit about the differences between first gen and first time. And then again, we'll get into kind of highlighting these programs and learning a little bit about what the different cities and counties are doing. So as always, just to start us out, why are we here? We do have some first-time guests today. And so we are here today really doing this work around best practices for down payment assistance. This work began a couple of years ago with a committee of experts that are kind of cross-sector, cross-city, DPA administrators, county, lenders, realtors, et cetera. And we continue this work with really the effort of believing that promoting standardization and transparency is going to help consumers and the industry alike, that we want to remove barriers and make down payment assistance less complicated. We want to increase funding to help meet the demand of consumers. As we know, this is continuing to go up every year with the cost of housing. And we're also starting to see a contraction in this space of down payment assistance. So wanting to raise up the value of it and continuing to increase our investment. And then really using this as a tool to strengthen our efforts to help close the racial homeownership gap. So not just creating down payment assistance to increase access to everyone, but to really think about how we might increase access in the communities that have been left out of homeownership. And then as we come together on this call quarterly, one of the other hopes is that you will start to build relationships with your peers, learn from each other, and we can raise up topics on these calls that are helpful to the work that you do, either as an administrator, as someone who refers people to down payment assistance, or someone who actually is working directly with the customer through origination. So the racial homeownership gap in Minnesota, this is not new information, but I think it's important that we always ground ourselves in it and that we remember the baseline of where we are at. So as we know, we have one of the highest homeownership rates for white households in the country, and we have some of the largest disparities when it comes to Black, Indigenous, and persons of colors, and primarily in the Black-white homeownership gap. So the largest gap that exists between white communities and BIPOC communities is between white and Black households. We saw a slight uptick in 2023 from the data that was available the year prior, but nonetheless, we still have one of the largest disparities in the country. So there's a lot of history as to how we got here. I will say when we're referencing specifically to down payment assistance, Minnesota has had a plethora of down payment assistance programs for many, many years. It's likely one of the reasons why we have some of the largest homeownership rates, but I think the criteria that has been used for down payment assistance historically, which is first-time buyer or low to moderate income, has continued to primarily serve white households. So while down payment assistance is great, it has not been very strategic in the past and has, I think, continued to add to this disparity and this gap in our community. So what is some of the differences between first-time home buyer and first-generation home buyer? So I think this is very familiar to most of us. In general, first-time home buyer, the kind of standard definition that's used with some nuances is that no ownership interest in a principal residence in the last 3 years. Often it's used as the criteria for CRA programs, low-cost mortgages, or for, again, as today, we're talking about down payment assistance. And 3 years, never having owned a home or not owned a home in the last 3 years often captures people who grew up in homeownership or maybe got out of homeownership for some reason, are re-entering homeownership. So it often tends to reach the people that have had either family or personal experience with homeownership. The first generation buyer is really about trying to reach those who have not grown up in home ownership and do not have access to the generational wealth that comes from home ownership. So again, there's nuances to this, but overall, the broad definition is the buyer and their parents or legal guardians have never owned a home. And I think what we know and what we've seen is, again, they have less access to generational wealth, and so therefore have greater barriers to access and sustainability. So it's often referred to as the bank of mom and dad, who might help with some down payment assistance to access the home, but also often are the resource if something comes up in those early years of home ownership when there isn't equity in the home. So you move into your home and you have to replace your water heater unexpectedly. You go out to open the garage door and it won't open, the worst thing ever. Can't get your car out, all those things. Often what happens is people rely on that generational wealth in the bank of mom and dad or aunt or grandma to help them with that. So first generation buyers often have barriers to access and have more challenges with preservation and sustainability. So before we jump into the spotlights, I just want to give a little bit of background. So first generation programs started to come online in around 2020, 2021. It started with some of our cities here in the state, and then has since grown and expanded to some counties that are doing this, as well as the two statewide programs, the Minnesota Housing Program that recently closed, and then the First Generation Community Fund. All of these programs were really started with this idea of testing this proxy of might first generation targeting as a criteria reach more BIPOC households in the communities that have been left out of homeownership. And no surprise, the answer is yes. But today, what I'm really trying to hope that we can relay to you is a little bit of kind of why these programs got started, kind of what they did at their local level, city, county, et cetera, to get these programs online. But then really how vastly different it is in terms of the number of BIPOC households we are reaching. So with that, I am going to start by turning it over to Jamie. You're on mute too, Jamie, just as an FYI.
Oh,
Okay,
sorry about that. I couldn't
no
see the button
worries. You're
to
fine.
put myself up.
We're all
So,
friends and family here.
gotcha. Thank you, Brooke, and thanks for inviting me today. So I'm Jamie Fritz. I'm the Housing and Economic Development Coordinator over at the City of Woodbury, in the Community Development Department. And I guess before I give our high-level overview of our first gen program, I'll just start off with, what prompted the City of Woodbury to start a first gen program in the first place. So I believe it was back in 2020, maybe 2019 or so. Our department likes to do a lot of different, types of training, especially, training that revolves around DEI initiatives, things like that. And one of the events that staff attended was one of the mapping prejudice presentations. I can't remember exactly when, the U of M started really promoting, that work that they were doing, but it was right around the time when that started. And, city staff went, I believe our mayor at the time also went. And going to that presentation really prompted a lot of internal conversation about what the city could do to help address, the housing disparity that we have now due to the long history of redlining and discrimination in the state. And prior to our first gen program, the city's HRA operated a couple different down payment assistance programs that started with the foreclosure crisis and trying to help people get into homes that were foreclosing in the city, which then turned into a standard first time home buyer program. So based on those discussions and what we already had, like what Brooke said, around that same time, some other communities were coming up with first generation programs. And we started to reach out to those other communities and, do some research about what was out there. And we came to develop what we have now, which was presented to our council. Well, I guess I should say our HRA Board of Commissioners, which is also our city council. Um, this new first generation program, and they all thought it was a great idea and decided to, implement that starting back in 2021. So that was our official launch date of our program here in the city. Um, so our definition of first gen has not changed since we implemented the program back in 2021. So it is a household and their parents or legal guardian do not currently own a home and have never owned a home in the past. We do not have the state definition, which includes, parents or legal guardians that have lost their home in a foreclosure. Ours is strictly they have never owned a home in the past. The amount of assistance that we offer to households is up to $30,000. So they don't have to take out the full 30,000 if they don't need it. But that is the maximum. Most households opt to take the full 30,000. And then our terms on this loan, so the 0% interest. So there's no monthly payments for households that take this loan. This is what makes it different from our first time homebuyer loan, which has a 3% interest. So there is a monthly payment for that standard first time buyer. The first gen program does not. The principal is deferred and it's deferred until the unit is either no longer owner occupied, they sell the home, or they do a cash out refinance. If they refinance for a better interest rate, or they refinance to get equity to make improvements to the home, then we don't require the principal be repaid. And to date, we've served, so since 2021, we've served 30 households with the first generation program. 71% of those households that we've served have been BIPOC households. The average income that we've calculated for our families is 89,000, so just over 89,000. Our income limit is 120%, and we go by Woodbury's area median income. So we look at the most recent American Community Survey 5-year estimate for the city, and then we do 120% of that. I'll kind of get into how we selected that once I get through the purchase price here. And then our average purchase price for these households is just over $303,000, and our maximum is $441,000. And we base our maximum on the annual county assessors report that comes out in the spring each year. So we take a look at that and we use 100% of whatever the median home value is in the city for that projected year. But going back to our income and our eligibility criteria, so our program is funded almost entirely through a HRA levy, property tax levy that we implement throughout the city. And one reason why we opted to use the property tax levy is that it gives us more, leeway and authority to make our own eligibility criteria and how we're going to spend the money. We do use a little bit of CDBG and home funds that the city receives, but I think as most other communities know, there can be a lot of restrictions with that and a lot of reporting and monitoring. That makes it a little more difficult. And then, when it gets paid back, there's those program income timelines that maybe you can't use it right away or put it back out into the market for another household to use. So that's why we chose to choose a income level that we thought was more in line with if there's a Woodbury resident who happens to be a first time buyer that maybe wouldn't qualify for an MHFA down payment assistance loan or would not qualify for CDBG either. We wanted to include those middle income households as well, in addition to households that might be on the lower end. So that's why I picked the 120% AMI for the city. And just in general too, we actually upped the income limit back in 2020 around the same time we were developing our first generation program. And that was really due to, even for a middle income family, the past, 5-8 years, just essential cost of living items have just become very, very expensive. And even someone who's income ready and could pay a monthly mortgage, the ability to adequately save for a down payment for a house is just extremely difficult, especially if you have children, medical emergencies, bills that you're still paying. I mean, I was recently paying for part-time daycare and it was almost, $25,000. And that was one of the cheaper facilities that we could find. So we really wanted to include those middle income households that are income ready and then also focus on, those that are maybe below the 80% AMI mark. And then another question that came up. So you anticipate continued investment. So in 2025, the HRA did adopt a budget that allocated more funds to this program. Our council is very supportive of the program. And, I think we've served almost 360 households since we started our down payment programs in 2009. So it's very popular. And it's going to continue to get investment. Um, this year, though, we are looking at some potential policy changes and maybe some operational changes to the program. Because one downside to how we fund it, so we choose to fund ours as a revolving loan structure. So when funds come back, we can put them back in the pot and they go back out to another household. But over the past 2 years, with the current housing market, we got hit pretty hard on those returning funds. So we pretty much just had our levy and our HUD funds and whatever came back to put back into the program because we saw a lot of our borrowers locking into their homes and not moving. But then on the other end of the spectrum, we saw a very, very sharp increase in demand because of housing prices, interest rates, and those people trying to get their foot in the door. So we really saw, well, I guess going back, so one thing we really pride our program on is that just about every single year up until now, we've been able to serve any household that wanted assistance. So we would always allocate more funds. If the budgeted amount ran out, we'd go back to council, ask for another 100,000 or whatever it was going to take us to get us through the rest of the year. But with, the current revenue returning, that was a little more difficult. So I think that's going to be one thing that we're going to take a look at moving forward. So I guess, one challenge we've had with our program, rolling out the first generation program went great. It was smooth and it's increasing in popularity. However, the revolving loan piece of that became very difficult and we didn't really anticipate that. So I guess if anyone's out there thinking about the revolving loan structure, we're kind of in a crazy time right now, but it's kind of one thing to consider is what happens if those funds stop coming back and you're relying on something that maybe, is a fourth or half of the funding that you need. But but overall, this program has been very successful. It's been very popular. And I guess another loan term to address, going back to the revolving structure. So we do make our loans repayable, even though we've noticed a lot of communities are going into the forgivable term for their program. But like I said, ours is revolving and we really only have the levy and what comes back to support future lending. So that's why we've continued to make it repayable.
Great. Thank
Yeah.
you, Jamie. I appreciate that. And I'm just going to say we're going to hold questions. We're going to get through our presenters and then we'll have time at the end for questions. But thank you for sharing some of that nuance because I know people are thinking about, well, what do you index to and how do you come up with these specific amounts? And I think this issue of revolving loans and liquidity is one of the reasons why we're starting to see some contraction in DPA because people are sitting tight. So with that, I will advance our slide here and we will move to Stephanie.
Yes, good segue, because as you can see in our first line, currently closed. Um, when I agreed to sit on this panel, we had a very robust program. Month later, we have suspended it. First time in 40 years, because ours is a revolving loan program with no infusion of money since 40 years ago. So like I said, we've had a down payment assistance program, not first gen, since 1985. And at that time, it was a very limited geographic scope. Edinburgh and the Centennial Lakes condominiums and townhomes were being built. And so we had a second mortgage program to make those more affordable. As those got repaid, the second mortgage, it financed the creation of an Edina Housing Foundation that operated our Come Home to Edina program. And so that really, in 2007, that program became citywide. And so, like Jamie was saying, I think a lot of city housing folks and people on this call probably saw the Mapping Prejudice presentation done by the University of Minnesota. And we, as a city, elected soon thereafter to join the Just Deeds and renouncing racial covenants against homes. But that didn't seem like enough. And there's housing groups that are gathered through LISC, and we'd meet periodically through ULI and the county. And at one of those meetings, I can't remember which monthly meeting in the summer of 21, I think it was Woodbury, was talking about their first generation program. In other cities. And I thought, okay, instead of just doing Just Deeds, where you can say, okay, I don't like this covenant against my home, why don't we try to make home ownership more accessible, more likely in our community? And without hesitation, the Edina Housing Foundation said, excellent, let's do it. Let's add it. Now we add it onto our Come Home to Edina program. So a borrower could borrow up to $90,000 through our Come Home to Edina program, and that's all deferred. In addition to that, if they're first generation, they could borrow $20,000 for first gen. And we borrowed Woodbury's pretty much definition of what first gen meant. It seemed the simplest at the time, and it was already in use. So we said, thank you. We'll use your definition. And because we had the Come Home to Edina that was deferred, this one is forgiven. It's to help with the additional assistance when in lieu of generational wealth. So we did not want it to have to be paid back. The other portion needed to be paid back. So this part was forgivable, but it was forgiven over time. We didn't want to, we're loan officers, essentially, putting mortgages on homes. And so we wanted there to be staying power. You sell your home in 2 months, you don't get the whole $20,000 back from the sale of that home. You get a portion, but every year we'd forgive $1,000. So this program started in November of 2021, and we closed on one in December. So we closed on one right away. And unlike Woodbury, in the same amount of time, we've only closed on 12. Still pretty happy about that 12, but not 30. But it did change the composition of our borrowers. The Come Home to Edina program did have a more diverse borrowing pool than the housing demographics of the city at large, but even more so with the first generation borrowers. Our average income is a little lower at 66,000. Our maximum we followed again, not like we're a bunch of copycatters, but I guess we are. Minnesota Housing's income limits. We thought some of these loan officers, they layer multiple sources of funds. You have your first mortgage, then you borrow from Minnesota Housing, some DPA, you borrow Come Home to Edina, you get first gen. So there'd be 4 mortgages on a home. And so we wanted it to simplify it as much as possible for the loan officers and the borrowers by trying to have some standards that were recognizable on a broader level. So we followed Minnesota Housing's with a maximum income as well as maximum home value. The average purchase price was $272. I think because our incomes were a little bit lower, and because housing values in Edina are so high, a lot of this does reflect townhomes and condominium purchases. So we, as mentioned, it's a revolving loan program. It worked as a revolving loan for 40 years. So January 31st, we suspended. We ran out of money. In 2024, we closed overall for the whole Come Home to Edina 25. We originated 25 mortgages and we satisfied 5. So when you're satisfying 1/5 of what you're lending out? Are you getting paid back 1/5 of what you're lending out with finite resources? We ran out of money. And I think there's a general agreement, although this hasn't been codified anywhere, that we won't reopen the program until we have 2 million, not 25 million, 2 million in paid back loans, because we want to add some security to loan officers and borrowers that are looking for homes, that we're not going to just pull the rug out from underneath them as they're shopping for a home. So I think I answered most of the questions, and I don't want to. A lot of what Jamie said about the housing situation, true for us as well. People are staying. It's rents are higher. It takes a lot longer to save for a down payment on a home because rents are higher, and housing costs are higher. So you need to save more. So it's like this perfect storm of situations in buying a home that make these programs more and more in demand, more and more necessary, and also makes that recycling element more and more challenging.
Thank you. I appreciate that, Stephanie. All right. Let's go to Ramsey County. All right, Tanisha, you're up.
Hi, everybody. The Ramsey County First Home First Generation program. The First Generation program launched in the fall of 2022. Before that, we actually had a first time home buyer program that started in 2001. It started in 2001, and when we got to 2020, 2021, we were looking and we just were not seeing the outcomes that we wanted to see. It was funded by CDBG funds, so they weren't very flexible. It was underutilized, and the demographics of the home buyers that were using these funds and using the down payment assistance program were nowhere near close to demographics of what made up Ramsey County. And so we were really looking to revamp the program so that we would get closer to the outcomes that we wanted to see. So in the fall of 2020, we revamped the whole program. We still have a first-time homebuyer program, but we also launched the first generation program. And some of the things that were really important to those that created the program was I think in the past there was just a focus on access. We wanted to give home buyers funds to access home ownership. It was really shifting. We wanted to provide enough funds to make home ownership affordable. So affordability is one of the main goals of our program. And so we wanted to reduce barriers of home ownership, make the home ownership affordable, and then to align with Ramsey County's economic inclusion and competitiveness plan. And there are goals that we have in this economic competitiveness and inclusion plan. So some of these goals were place-based inclusion. We see a lot of certain demographics in St. Paul, but what about the suburban cities? We wanted to create resilient and equitable communities by expanding affordable home ownership opportunities. And then we wanted to also provide access to affordable home ownership to communities that had historically been left out of home ownership or had experienced wealth extraction. So those were some of the things that some of our goals and some of the reasons why we created the program that we have. So we have a first generation program. We use the same definition as I think we got it from Woodbury. Buyers have never owned a home in their lifetime, and neither have their parents. For our first generation program, we are offering 25% of the purchase price. The maximum purchase price that we allow is 372,600 is the maximum purchase price. I don't know the exact reason why they settled on that, but what I do know is that affordability is really important, and maintaining affordability. When we throw in taxes and we look at the income levels of people buying, we wanted the homes to remain affordable. And so because that 372.6 is our maximum purchase price, the maximum amount of assistance a buyer can get is 93,150. And this is I'm often approving 90,000, 88,000. We often have buyers accessing this amount of DPA. It is an interest-free loan, and then it is forgiven at 5% each year that the buyer remains in the home until 20 years, which is totally forgivable. Since the relaunch of the program in October 22, we have served 61 families. In 2024, we're really happy. In 2024, we served 46 families, and that was basically from January to we closed down in August because we ran out of funds. 93% of our buyers are BIPOC, and that is more in line with the demographic makeup of Ramsey County. The average income is 64% of the AMI. When we look at income eligibility, we really want to serve those families that are most in need in Ramsey County. So the maximum income is 80% of the AMI if it's a household of 1 to 3 members. If it's a household of 4 more members, the maximum income jumps to 100% of the AMI. And then just really one of the important things in Ramsey County, with it being the second largest county in the state, we really, the way we look at housing is on a continuum. Our deputy director that helped design this program, and then myself, we came from actually housing stability. So we worked on the full housing continuum from homelessness, from like HUD homelessness, where people don't have a place to stay that's meant for human habitation, all the way to home ownership. We look at this as a way to free up affordable rental homes in Ramsey County. We have a huge homelessness problem. We don't have enough low income, like 30% AMI rental housing for people that are homeless. And so when we are opening up home ownership opportunities for people that are at the 60% AMI level, 80% AMI level, that frees up naturally occurring affordable rentals in Ramsey County. It frees up tax credit rentals in the county. And so getting buyers that typically maybe would not be able to access home ownership in their income level, getting them into affordable home ownership, that has also helped us create affordable rental income and is helping to chip away, I'll say chip away, at the homelessness problem in Ramsey County. Even though people are not always buying from Ramsey County, they really buy from all over the metro.
Do you
Yeah.
see this program continuing to be funded? And then can you just talk a little bit about how you guys, I mean, I know people are doing the math because you guys have one of the larger DPA programs in the state. So can you just talk a little bit about continued availability and continued investment?
Yes. So Ramsey County leadership, meaning the county manager, the board of commissioners, they're very pleased with this program. And so they definitely want to continue the program and are willing to invest in it. And we also are funded by the Ramsey County HRA levy. And we chose that because it's more flexible than CDBG. It's a reoccurring income. And so with that, we're not in danger of things happening with federal funding. This is something that will definitely continue. Um, Everybody is really pleased with this program and committed to the continued funding. We just got a new round of funding in January, and it is a pretty hefty amount. It's a good amount of our yearly annual HRA budget. So I'm hoping it'll last to the end of the year. I don't know that it will, but yeah. One of our goals that we succeeded in, and for anybody that's looking to do this, is to try to make it as barrier free as possible. I think both of the previous speakers have already talked about the fact that a lot of buyers that are buying first generation, they don't have experience. They didn't grow up in a home where the parents owned, and so they don't know the process. They're unfamiliar with it. A lot of times they're scared of the process. So to make the program as barrier free as possible. We don't do a credit score. We try to just take away, we don't require a credit score. We don't do underwriting. We get the absolute minimum that we need to determine that they're eligible, and then the minimum documents we need to make sure that the sale is on the up and up. And that is helpful.
Great. Thank you so much for that presentation.
Thank
So
you.
before we open it up for questions, I'm just gonna quickly highlight the statewide programs, which I think, are also have been a great learning lesson and impactful. So just as a refresher, in 2023, the legislature awarded $150 million for a first generation statewide program. That was a huge win and born out of the efforts of this work and building off the experience of the cities that had been doing this work. And so just an amazing opportunity, perfect storm in the right way, Stephanie, of like available funds and a lot of emphasis and acknowledgement that our state has underinvested in home ownership. And as you pointed out, it's kind of a continuum, moving people into affordable home ownership, frees up affordable rental, and on we go. So these dollars were awarded, and then the 150 million was split into two pots. 100 million was allocated to the first generation homebuyers community DPA fund, and 50 million was allocated to Minnesota Housing's loan program. So the community fund launched in June of last year, and this definition is abbreviated here, but it is essentially buyer, their parent, legal guardians has never owned a home. And both of the statewide programs did make an exception for foreclosure, and that was written into statute. And a part of that was just the acknowledgement of a lot of the communities that were hard hit through the foreclosure crisis were the communities we were trying to reach. Um, and then both of these loans are forgivable. The community fund is 10% of the purchase price up to 32,000, and then 20% is forgiven each year. And so essentially it's fully forgiven after 5 years. And we were focused on addressing accessibility and then also wealth creation and wanting to build equity early in the home ownership process to help support preservation so that people have access to liquidity and equity to address issues that may come up with the home, because again, they're unlikely to have access to the bank of mom and dad. The program so far through December has reached just under 500 households. It's spent down, I think, to about 71%, 70%. So we anticipate the program will be available through much of 2025. And 88% of those new home buyers have been identified as BIPOC. We are currently at the legislature making an ask and trying to take this program from a pilot to a permanent program. We do know that this is a huge lift, but we do believe that this is a good use of public resources. We all know the economic impact of home ownership in our community, and we believe that there is a commitment of using public funds to redress some of the issues and some of the disparities we have in home ownership. And then we too, for this program, trying to make it simple. I think, as Stephanie pointed out, as others pointed out, so we're using the Minnesota housing guidelines for maximum purchase price as well as income, and just trying to simplify it and remove as many barriers from the transaction as possible. And then I was able to request some data from Minnesota Housing on the program that they had that closed. I think it was more or less December, maybe early January that closed. That program began in May of last year. Again, having the same definition for first generation buyer, which hopefully fast forward soon enough, maybe we can all get to a place where there's a universal definition for first gen buyer. But their program offered $35,000 of assistance, and then they have a forgivable loan period at half at 10 years and half at 20 years. And they were able to reach just over 1,300 new homeowners during that period, and 82% of them were BIPOC. You can see that both the average income and purchase price were well below, if you're familiar with startup income limits and purchase price, both well below. So with that, I just kind of want to give this like visual. We've touched on it. We've named it. We list all the kind of the percentages that we reached. But really, this is the difference. So our bottom line here shows for the comparative program for each of the ones that were highlighted today, the number of or the percentage of BIPOC households served for first-time home buyer as opposed to first gen. So this was the proxy I think that all of us were testing. I think it's been demonstrated as effective. And I think if you are considering making available down payment assistance in your communities and through your funding sources, having a percentage of that DPA allocated to first generation buyer, even if your product terms are not dramatically different than first time buyer, is going to result in a higher percentage of BIPOC households becoming homeowners. So I think the data and the numbers speak for themselves. And we're really hoping that you guys can help carry this message. We really want to socialize this locally and, to be honest, nationally. I think this is an opportunity. And, you know, it's not as controversial as some approaches. It is open to anyone, no matter their race, as a first generation buyer. It just happens that in our community, the majority of first generation buyers are BIPOC due to the systemic issues that we have faced and the targeted approaches we have taken. So with that, I would just like to open it up for questions, thoughts, all of the above. We got some well dones and some congratulations. Love to hear from people. Um, and also great job. I mean, you guys were willing to be the some of the first to market to do this, and I think that's great. Any questions for any of our panel of speakers?
I was just wondering if anybody was planning to use their sales tax funding to help with the programs, or this is part of their strategy with that money.
Great question, Tanya.
I can respond to that a little bit. It has been proposed. You know, we get $600,000 in LAHA, roughly 6 to 7. And the doors have opened with people making requests of how those funds should be used. With this being one possibility, 600,000, my fear is if we use anything shy of that. Last year we went through $1.5 million of funding for our mortgages. And again, I don't want a partial year or a less than 6-month year on this because I think it just creates a lot of insecurity. My hope is that we're going to find a more robust amount, but that is an option.
We have considered it. However, in light of things that are going on with federal funding, we are not, we decided not to make any decisions until we see where the cars fall. Yeah.
Good
And,
question. Go ahead,
oh,
Jamie.
I was just gonna say at the Woodbury level. So we're still having discussions with our city council to figure out how we want to use those LAHA funds, and we're gonna have a workshop in April to kind of finalize direction and programming for that. And really, I think, you know, down payment has been brought up in our current programs, but also, you know, other areas where we've been dependent on, you know, other entities of government for funding, whether it's HUD, county, state, you know, where can we fill gaps with that for projects that, you know, may not have happened in the past, that maybe might be new construction or rehabilitation, things like that. But DPA is definitely, you know, something that's been talked about.
Great. Thanks, Jamie. So we have a question, Tisha. Can you talk a little bit about a potential concern around risk or default with such high assistance? It sounds like some of the pushback potentially of how do you explain risk to anyone who's concerned with such a high subsidy? So do you guys, does that come up for you guys in terms of like, well, what happens if you have default, or what happens if borrowers need more assistance and you're providing such high assistance to people who maybe need so much this isn't even quite affordable for them?
So It hasn't come up often. We do allow layering in a lot of programs. You know, we allow layering as long as the housing DTI doesn't fall below 25%. So oftentimes I am giving DPA and there's other amounts being layered to make it affordable. We haven't run into that much default at all. The only situations I've actually seen that have come across my desk have to do with, which is a really hot topic, has to do with homeowner association assessments that are becoming a big issue. But as far as default and affordability, it's the default is not coming up at all that I've seen. In affordability, we do allow layering because we really want to make, you know, the payment affordable.
So maybe another way to ask this question too, and it seems like you have a lot of support and you have a lot of buy-in, but I imagine you've gotten the question, even maybe from some internal partners, why such a large investment? How do you justify such a large investment? Do you get that question?
We do. And so one thing is, again, our focus and our goal is not just access to home ownership, but is to be affordable. And then I give examples of you know, when I first started here, because I just started in September 23, I'm thinking these are huge amounts, man. Their payments are going to be so low. It's rare that I still see, even with $93,000 in down payment assistance, that I still see a monthly payment under $2,000. And when I explain that to people that ask the question, usually they're not doing this on a day-to-day basis. They're like, oh, I'm like, it's making it affordable, but it's needed because these payments would be 3,000, 3,500. And so when you start talking about the numbers of it all, then it kind of clicks and makes sense.
Do you guys have a maximum DTI? You mentioned a minimum housing ratio of 25. Do you guys have a maximum debt to income ratio?
45%, and we can go up to 50 with manager approval, but don't like to, but
Yep.
you know, yeah.
So that's another way that you kind of protect for avoiding risk and default is that they're not getting more house than they can afford or payment higher. Because I think FHA right now is going over 50% in some
Mhm.
scenarios. So
And I've had some. I had one. I honestly did not think that the couple could afford it. And I tried to talk to them, and their lender tried to talk to them, because they were right at 50%, and these things were tight. And I'm like, you're gonna get in this house, your taxes are going to go up. We were, you know, explaining these things. Ultimately, it was their decision, and they went with it. But there's only been one out of the 50 or so that I've done.
great. Okay. Thank you for that question, Hillary. Other questions or thoughts or comments, or if anybody wants to share some of the thoughts that they're having about creating programs or conversations that are being had about developing programs?
I do have a question real quick. This is Phil Olson with Cross Country Mortgage. Um, we're starting to see, or we have been seeing throughout the industry for about the last year, a lot of condo associations being dropped off the rolls from Fannie Mae, Freddie Mac, um, FHA, due to these associations not taking care of their maintenance. So right now we're seeing, I swear, maybe 50% of all condos in the state of Minnesota no longer can get financing. Is that a concern for you guys? You know, if an association um, is compliant and then we get them into the property, but then the association doesn't take care of their maintenance to where these clients can't sell their houses. Have you ran into that?
Um, so I haven't ran into a situation where a homeowner isn't able to sell, but it is a huge issue for us. Last summer we just did a very surface level study of condo associations in Ramsey County. We got the number of condos in Ramsey County. We got the number of condos that were built before 1978, and the numbers were staggering. And then I've had two situations where I've had pretty new buyers. I mean, one was not even 30 days, and the other was less than 2 years, slapped with like $10,000 assessments. So it is a huge issue for us. I hadn't heard about Fannie Mae and FHA not willing to fund some of them. For me, that's not a big issue. I would rather have funding say, you know what, this is not a good investment before somebody sinks everything they have into it. But I know there's going to be more to come on that. We took in our study, we're trying to figure out what to do with it. Because Ramsey County has some homeowner repair and rehab programs, but it's limited about with what it can do in a condo association and how we, you know, because we do individual homeowners and how we want to look at that. But it is an issue, and I feel like in the next 5 years, there's going to be a lot of conversation, a lot of work groups. There's going to be I think that's going to be a hot button issue.
Yeah, I would agree. There's a lot happening right now. There was a group that was pulled together after the last legislative session to discuss HOAs and make recommendations to the legislature this year. So there is some stuff coming through. But I would say that HOAs in general have been a hot topic issue for the last 5 to 6 years, all the way from like how easily they can foreclose on consumers to the exorbitant fees for just simply asking a question because they use attorneys. And I think more and more we're starting to see in parallel with the issue around insurance and denying of claims and associations being underinsured and then passing that on to the owners. And so it's definitely something I think we are all talking about and trying to figure out what is the strategy, the approach, both at a legislative level to regulate HOAs and then as a way to help preserve and keep people in their home. Because I don't know about you, but if I got hit with a $10,000 bill that I just needed to pay for my association because they were underinsured or had deferred maintenance, I mean, that'd be a huge barrier to overcome. So
I'm
thanks for
seeing,
that. Yeah.
I'm seeing that almost on a monthly basis
Yep.
right now.
Yep.
You know,
So, mhm. Thank you for that comment. Any other questions or thoughts or ideas, concerns, discussion items before we wrap up today? Let's see, we got some questions, a couple of quick ones. What's been the most effective marketing approach to reaching those with the greatest need? I don't know. Jamie, do you want to take that? What do you guys do for marketing?
Sure. So I think, our main strategy and one of the, biggest efforts we do is we just go out to local lenders, realtors, and, meet with their teams one-on-one, explain the program, give, tips, advice, guidance on, how they should talk to their buyers about it, things to remember. Just so they're not going like, oh, you can get $30,000 here and, not explain it's a second mortgage or direct them towards the, first time home buyer courses that are available throughout the metro. And I think going directly to the buyers, we do a lot of community engagement activity here within the city. And typically, that leads, just one interaction with a resident or some other community organization has led to, events here at City Hall that have been housing specific. Like one interaction led to a, event that we did here for our, for a group of East African residents that, lived within the city and they were curious about housing options and home ownership and things like that. So we facilitated something here. I think over 60, 50 people attended it. So it's great turnout, but definitely word of mouth and definitely trying to just, post things where they're going to be visible to different groups of people based on kind of, interests or needs and things like that. So definitely going directly to the buyer and directly to the lenders and the realtors.
Great. Thank you for that. All right, I think we will wrap there. I'll just note that our next session will be on May 8th. And so I'll start to advertise and promote that, I don't know, 6 weeks beforehand. But if you want to put a little save the date on your calendar, please do so. But thank you, everyone. Thank you again to our guest speakers. I really appreciate you guys coming on and sharing about your programs. And thank you to everyone who was able to attend and participate today. And then again, this video will be posted on our website. So if any of your peers and colleagues were unable to attend, or if you think this would be good information to share with decision makers in your space that might be considering the value of DPA and approach, I would encourage you to do so. So thank you.